Hey, what's up guys? Welcome back to the channel. My name is Frank Mularcik and this is episode 11 of my Dow analysis series in which we're going to be analyzing every single company in the Dow. So in this video, we're going to be analyzing the 10th smallest company in the Dow by market cap, and that is Honeywell International, ticker symbol HON. So the first thing we're going to be going over is sort of just their business, what they do, looking at some other things in the 10K annual report. We're also going to be looking at their most recent earnings report from the first quarter of 2022. We're going to be looking at some dividend information to try to determine how safe the dividend is, how secure the dividend is, stuff like that. And we're also going to be looking at some valuation metrics. Firstly being the PE ratio, secondly being a discounted cash flow model, and then we're also going to look at some more technical indicators to give us an idea of what price we would want to buy the stock at.
If you find value in my videos, make sure to like and subscribe so you don't miss out on future content. This is Frank Mularcik.
So firstly, like I said, just looking at the 10K report, this first little section is just kind of the CEO's letter to shareholders. And the first thing I wanted to kind of look at was acquisitions. So they had a few acquisitions in 2021. These are what they call significant transactions, I guess, in 2021. So these are three basic acquisitions, and I'm not going to read through all of them, but all three of these are sort of centered around software that's going to complement Honeywell's products and services that they already offer, essentially. And they're also getting into quantum computing, which I think is pretty interesting, as that's something I was talking about a little bit in the last Dow video I made with IBM. That's something IBM is getting into as well, and I think that's a pretty good opportunity. They say it's projected to become a $1 trillion industry over the coming decades, which is pretty cool, and they're already working with customers such as JP Morgan, Merck, and DHL, which is good to see. They kind of have some customers already. So Honeywell's business is basically split up into four segments. The first one being aerospace. So they just say it's a leading global supplier of products, software, and services for aircraft that it sells to OEMs and other customers in a variety of end markets, including air transport, regional, business, and general aviation aircraft, airlines, aircraft operators, and defense and space contractors. So a lot of, basic aerospace stuff there. They have the next segment, Honeywell Building Technologies, which is a provider of products, software, solutions, and technologies that enable building owners and occupants to ensure their facilities are safe, energy efficient, sustainable, and productive. So I think there's a lot of potential with this kind of business in the software realm, in terms of like monitoring stuff in general, and looking at threats and maintenance and stuff like that seems kind of boring, but for a lot of companies is pretty important. And then the next segment here is performance materials and technologies. So they're basically focused on developing and manufacturing high quality performance chemicals and materials, process technologies, and automation solutions. And then the last segment here is safety and productivity. So they're a provider of products and software that improve productivity, workplace safety, and asset performance to customers around the globe. Next, we are looking at the balance sheet in this 10K report, and they're first of all looking at current assets. They are down a few $1 billion from 2020. The main difference though is in cash. So they have about $11 billion of cash compared to around $14 billion last year, and that's just a trend that most companies are following, that they basically held on to more cash during 2020 because of various uncertainties, and then now that that's starting to kind of taper off, there's less uncertainties, I guess, within their business. They're not holding on to quite as much cash, so that's sort of expected. In terms of total assets, pretty much flat there. Current liabilities pretty much flat as well, we can see current liabilities are $19.5 billion, which is less than the current assets. So that means their current ratio is greater than 1. And basically what the current ratio is, you take current assets divided by current liabilities, and that basically is going to give you a picture of whether they can pay off all of their current liabilities within the next year. So this current assets is basically all of the assets that they will have within the next year, essentially, and current liabilities is what they will have to pay out within the next year. So if they can't, if they don't have enough to be able to pay out within the next year, that is potentially something that is an issue or can be a little bit of a warning flag sometimes. And then looking at debt as well, so they have about $14.25 billion of long-term debt. And then the current portion of that long-term debt is about $1.8 billion. And they also have some short-term borrowings of about $3.5 billion. So when you add all that up, that's about $20 billion of debt, which is down by about around $2 billion from last year. But when you look at the debt to equity ratio, they have about $20 billion in debt, like I said, and their equity right here for shareholders is around $18.5 billion. So their debt to equity ratio is a little bit over 1, which generally is not the best thing, but that basically just means that they are financing their activities more through debt than through equity, which again is not always bad. And it really depends a lot on the company and the industry. They're in the industrials sector, in the conglomerates industry, and one of the other big companies in the conglomerates industry is 3M. So we can kind of compare them to 3M a little bit. And 3M does actually have a debt to equity ratio which is less than 1. But some of the companies in the conglomerates industry have a debt to equity ratio greater than 1, some a little bit less than 1, but generally most of them are around 1. So I think Honeywell, is sort of in that range, so it's not that big of a deal. But I would like to see them reduce debt just a little bit. But again, like I said, it's not a huge problem. So next up, looking at the Q1 2022 earnings, they had revenue of $8.4 billion, which was actually down 1% year over year. But that essentially was expected from the guidance, and they're kind of on the high end of the guidance. And then earnings per share similarly was down about 1%, which they said down here. Adjusted earnings per share was $1.91, which is down 1% year over year, but it's 1 cent above the high end of the company's guidance. So essentially, revenue and earnings were down just a little bit, about 1%, but that's kind of what they were expecting. And it was not as bad as they were expecting. So obviously it's not good to see decreases in revenue and earnings, but they were sort of expecting it. And they also talked about at some point down here, maybe I passed it, the expectations for next year, or for the rest of this year. So they are updating their outlook for the full year. So their full year sales are now expected to be in the range of $35.5 to $36.4 billion, which is basically a 4 to 7% increase. And then their adjusted earnings per share is set to be between $8.50 and $8.80 per share, which is up 10 cents on both ends from their previous guidance. So essentially, they're increasing their guidance, which is good, but their results really did not show much growing earnings or revenue, which is something I would really have liked to see. And next, looking at the dividend from Honeywell, their current yield is right around 2%, which is, for a dividend company, it's a little bit on the low end, but there's nothing wrong with that per se. Their payout ratio is pretty low at around 48%. So, given the quote unquote lowness of the dividend yield, I would say the payout ratio is pretty much in line with that. They have been growing the dividend fairly nicely at around 7% per year on average for the last 5 years. And they have been growing the dividend for 12 years consecutively. This says 18 years, but that's just wrong. It's 12 years. It says that on Honeywell's website, and it says it on other data sources that I often look at. So overall, I think the dividend is pretty solid. Again, it's a conservative dividend yield around 2%, but they do have that dividend growth, which is fairly nice. Certainly a lot higher than certainly a lot higher than 3M's dividend growth, which is a positive to see for Honeywell. And now looking at the PE ratio, what I did is I took the PE ratio data from Macro Trends, put it in Google Sheets just so we can see our own little charts a little better and get some more data from it. So this is the PE ratio basically since 2010, and it's been going up a little bit. Right now it's around 25, and the average basically since 2010 is around 20. And similarly, since this one over here is just zoomed in a little bit, since 2015, pretty steady in the 20 range aside from this anomaly up here. And the average in this time period is 25. So kind of both time periods, they're a little bit above the average historically. But these few years in 2018, or these few quarters, is a bit of an a bit of an anomaly. So if we kind of just delete these values and say they're kind of outliers, what we get is something that looks a lot more consistent and a lot lower of a PE ratio on average. So from the full last 12 years, the average is around 17.5, and from the last 7 years, the average is around 20. So from that point of view, Honeywell is a little bit overvalued from the PE ratio perspective, at least compared to where they've been at historically. We can also compare them to their overall sector. So they are in the industrial sector, and the average for the industrial sector is around 21. So Honeywell is a little bit above that. And if we look in the conglomerates industry, which is where they're actually the biggest company in the conglomerates industry. The average for that industry is around 20. So again, they are above that average, which is not the best thing to see from a valuation perspective. When we look at the discounted cash flow model for Honeywell, it does not paint the best picture. So the fair value I got when I did this calculation was around $124 with a 10% margin of safety. That gives us a buy price of around $111. And compare that with the current price of $195, and it looks like Honeywell, from this discounted cash flow perspective, is pretty overvalued at this point. One of the things I did notice while doing this calculation was that Honeywell actually had decreasing earnings and revenue even before anything going on with COVID in 2020. From 2018 to 2019, their revenues and earnings decreased, and then they decreased again, obviously in 2020, which is expected. But that's just kind of a sign that I really don't like to see from them. And sometimes, companies will focus on increasing profitability, and at that point they realize that their revenues will decline. But that didn't really happen with Honeywell. I don't know if that's what they were trying to do, but if that is what they were trying to do, it didn't really work because both their revenues and earnings decreased. So again, that's really something I don't like to see. And given that their earnings, in 2022, the first quarter, like we talked about, revenue and earnings were down year over year. Again, just not good signs there. And finally, looking at a little bit of a chart here, we can see this is a 5-year chart, I think. Actually, this is a 10-year chart. And we can see sort of a long-term trend, just up and to the right. And based on that trend, the current price doesn't really look that bad. The current price around $195. Kind of the end of the trend line is around $200 here. And so from that perspective, the price really doesn't look that bad. But when we zoom in a little bit, I don't really like what I see quite as much. So on the 1-year time frame, there's a lot of volume right here in the 195 range, which is pretty much where we're at right now. So from that perspective, it doesn't look that bad. And there's at least this little bit of a bottom that we kind of bounced off around 175. And if we look actually out to 5 years, which is a little bit longer, it does look like there's a lot of volume around this 150 level, and there's not nearly as much volume up here. So from that perspective, it seems like it could fairly easily fall down a little bit more towards this 150 level. And so from a chart, I would really want to see it, closer to 175, below 175, 150, something like that, before I was more interested in the stock, I think. So overall, I think Honeywell's business is very exciting. A lot of the products and services that they're executing on, a lot of the technologies that they're working on is pretty exciting to me, and I think it has a lot of potential. But unfortunately, it just doesn't seem like they're really executing on it super well, and they are having revenues and earnings that are decreasing over the last few years. Obviously, some of that is warranted, but the fact that they had decreasing revenues and earnings in 2019, I really don't like that. And the fact that they don't really seem to be recovering nearly as much from 2020 as a lot of companies are. I would have liked to see them recover more, and I'll look for them to recover more from that. Their revenues and earnings are still below, pre-pandemic highs. So I definitely want to see those numbers be able to break above the pre-pandemic highs. And in general, I just want to see a little bit more growth there. like we said from the balance sheets, debt is not that big of an issue, but a little bit of a reduction in debt would not hurt. Along with the dividend, I think the dividend is pretty solid, and if they can just continue increasing the dividend around that 7% per year, like that is pretty solid for Honeywell, I think. But because of the valuation things, and some of the things we saw with the PE ratio, I really think that this price is too high for what Honeywell is really worth. I think something between 120 maybe 150 would be a lot better price for Honeywell, and I certainly wouldn't be interested in it until it was closer to 150. So let me know what you guys think of Honeywell down in the comments below. Definitely, I could be wrong there. Maybe I'm being too critical of the company. I don't know, but this is just my opinion and what I've kind of learned doing some research on the company, and hopefully you guys can find some value in that. So let me know what you think down in the comments below. Just want to thank everyone for sticking around to the end of the video, and I'll see you all in the next one.